Hi, my name is Philip Reed, and I am the President and CEO of Phoenix National Business Group. Today, I'm going to give a presentation as to what my company does, what we stand for, and what we are about. Phoenix National Business Group is an online marketing, media, and production company that produces websites, professional social media platforms, and online video productions for companies, places of worship, and entrepreneurs. Our programs also includes a unique series of talk shows and online events that empower the public with information that will improve their lives, with positive, uplifting messages reflecting the love of God and His vision of grace and restoration for the world. We have and are pulling together a network of entrepreneurs and leaders that seek to change the world with the fundamental belief that without hope, dreams die. Not only do we develop and produce these programs, we also establish platforms for distribution through our social media presence, which has thousands of viewers throughout the internet. We also have our own channel, PNN, Phoenix National Network, that goes out to millions of people across the world on Roku and Amazon TV. Our motto is, when you win, we win, because we believe in helping normal people and businesses do extraordinary things by developing, creating, and publishing their ideas to the world. This is what Phoenix National Business Group does, and we do it proudly. If you would like more information about the services and products that we offer, please feel free to visit our website at phoenixnationalbusinessgroup.com, or you could give us a call at 914-297-PNBG. That is 914-297-7624. We do look forward to hearing from you, and see you soon. Phoenix National Business Group is now offering their online services on Roku and Amazon TV for only $99.99 per month. This is a limited time offer, so give us a call at 914-297-7624 for more information, or visit our website at phoenixnationalbusinessgroup.com. That is phoenixnationalbusinessgroup.com. See you soon.
All right. So we are back with our Power Up event for the month of October. And so we're talking about how to improve your business and finance and your personal life. Welcome back to the program. We have a special guest today with us, and I'm going to ask Oscar to introduce him because he knows him best.
Absolutely.
Oscar.
Wait, hold on. Yeah, Barry White's on the phone. He wants his voice back.
No, it's mine. It's mine forever.
So that's the way we're going to start today. So I want to introduce. When did your name become Richard? That's so formal.
I like being formal. I'm trying to be formal here.
Ricky Cuizio, as we know him, part of our Master Networks group. He is he's actually doing the refinancing on my home. And when Phil said we're doing business this month, I said I got someone that you might be interested in talking to. A lot of people don't know about how to get financing for their home or how to refinance their home, or if they even should be refinancing their home. So Rick is the expert. I figured, bring him into the fold. So Rick, it's all yours.
Thank you guys for the introduction and for the time. I appreciate it. The only voice that could probably top that Barry White, Phil, would be Morgan Freeman. So if you,
Oh wow, yeah, wow.
I mean,
That's your next video.
Oh, y'all are bringing me to tears, man. I'm serious. Oh my God. I'd like to thank my mother.
As they said before, I want to introduce myself. My name is Richard Cuizio. My friends call me Ricky. I go by Ricky, but Richard does sound more formal. I am a loan officer with Hudson United Mortgage. I am also licensed in New York, New Jersey, Connecticut, and Florida. Once again, I just want to thank Phil Reed and Oscar Capel for inviting me to do the segment on today's show, and hopefully I can give you guys some insight on pre-approval or refinancing process if you're a first-time home buyer or in the market to do a refinance because the market's hot right now. A little bit about me. I grew up in Florida. Even though I was born in Brooklyn, I did grow up in Florida for 34 and a half years of my life. Moved up here 3 years ago for change in lifestyle and career. And it honestly was probably one of the best decisions that I have ever made for myself. Before coming to work with Hudson United Mortgage, I was the branch manager for Trustco Bank over in Pelham. And I did that for almost a year. And that's how I got my foot in the door and understanding with retail banking and the mortgage industry. So to dive right in, today I'm going to discuss just the first steps and acquiring a new home, doing a refinance, and maybe give you guys some helpful tidbits on how to prepare financially and mentally so you can acquire the home of your dreams. First off, we can do single family residences or 2 to 4 unit multifamily residences as well, condos, co-ops. We have a bunch of different products that we work with. We are also a brokerage, so we work with 40 direct lenders. If I don't like a product that one lender is offering, I do have the capability to provide better customer service by going somewhere else and maybe even getting you guys a better interest rate as well. But like I said, we're here today because some of you might be interested in buying a home of your own or doing a refinance. Now is the time to buy. I mean, we are at a historic, this is unprecedented for low rates in the mortgage industry. And for the reports that I've been reading and the sources that I've been reading, it might stay that way for the next few years, but we don't have a crystal ball. None of us do. If we did, I can guarantee you I'd be playing lotto in the stock market and I'd be living on my private island right now. So, but only time will tell. So that being said, in today's market, when you go to buy a house, the homes seem to be going for over asking price, and they seem to be going to the highest bidder with the biggest down payment. It's not required. It's not part of the law. It's just the nature of people giving into their natural instinct of greed. In order to place a bid on a house, you'll need to get a pre-approval letter and acquire a realtor to issue to the seller's realtor and to the sellers themselves. So that brings us to the very first step of getting pre-approved. Now I'm going to share my screen. All right. Let's start from the beginning here. You guys see it? Can you see my screen? All right, good. Here's my information. If anybody has any questions after the segment or want to call me in their own personal time or send me an email, please take a screenshot. I'll leave it up here for a few seconds. And I know Phil's got my information and so does Oscar as well. So feel free to give me a call. That's my cell phone. I kept the Florida number. 15 years. I don't want to change my phone. Call me stubborn. That's my work number. I've got my website and my email as well. What is a pre-approval? A pre-approval is a conditional commitment to lend. There's certain criteria that is looked at and taken into consideration, not just by me, but all loan officers and lenders in general. When issuing the pre-approval, it is not just the conditional commitment to lend, it's the loan officer or banking institution's blessing on saying, yes, we have done our due diligence for Mr. and Mrs. John Doe on financing their loan. And we're putting our reputation on the line saying that we have done our due diligence and we feel confident in issuing you the loan. So there are the way to go about qualifying you for a home of your own and getting that pre-approval letter is by verifying 4 simple things: income, assets, your credit, and your expenses. All right. Verifying your income. This is one of the things taken into consideration when calculating your DTI, aka debt to income ratio. I'll come back to that in a little bit, but for your debt to income ratio does consist of 2 magical numbers that we want to keep in line when we're qualifying you for a home or a refinance. When verifying your income, we also want to document a minimum of a 2-year work history. That doesn't mean that you have to be working for your current job for 2 years. We just want to make sure that you have a 2-year work history, especially if you're doing an FHA loan, which I will get later on and briefly explain later on in the segment. But in order to qualify you for your income, we need your 2 years of W-2s, and we need to look at your pay stubs. We want to make sure you're working, and we want to see what you've been making for the past 2 years. If you are retired or if you're a self-employed borrower, then we're going to need your business tax returns, your personal tax returns to see, and your 1099s to see what you might be making from your Social Security or your pension. And we want to see your business tax returns to see what you're making as an owner of your business. So business tax returns, you might schedule them a little bit differently. You might have a K1, you might have a Schedule C, but we're going to need all that stuff in order to qualify you. So that being said, the next thing we're going to look at are your assets, because that is a big, how come this, there we go. Assets. We need to verify any and all assets in order to qualify you for your mortgage. We want to make sure that you have enough money saved up for your down payment and for your closing costs. If you plan on putting 20% down payment, then we want to make sure that you have 20% of that loan in your bank somewhere, checking, savings, CD, annuities, stocks, bonds, retirement, anything like that. We need to verify those assets. Depending on which city, village, county, or state you might be residing in, closing costs are going to vary, and so will the property taxes. So in order to verify those assets, we ask for 2 months of your personal and or business bank statements. If you're going to use 401k, we would like to see your 401k statements. Annuities, stocks, bonds, we need all of that. 2-month history has to be documented. Now, when it comes to retirement, most lenders, by the Fannie Mae and Freddie Mac guidelines, we will only accumulate or account for 60 or to 70% of your 401k. So let's just say your 401k has a balance of $10,000. Conservatively, we're only going to use about $6,000 of it. So we can't use all of it. I mean, let's face it, it's retirement money. It's for the end of the road. It's for life after work. But it is there. You can use it. Little trick of the trade, you can also do a 401k loan. It does not impact your credit if you need some cash. You can take a 401k loan out, pay yourself back over X amount of years at a very favorable interest rate. I've done one myself when I was in a bind. I did one a few years ago, and I think I had a 6% interest rate over a 3-year period for with Fidelity when I took out my 401k. So it can be done, but each retirement plan has their own rules and regulations. So you just have to see what they are. I cannot stress this enough. No cash, no cash, no cash. No cash deposits, no cash withdrawals. We cannot paper trail it. So if you have cash in your sofa, in the roof, in your safe, do not make any deposits, large deposits or withdrawals of cash that we can't paper trail. If you're thinking about using that money, my advice, get it into your account months in advance and keep it there, because we only need to document so far back. They're going to question cash deposits. We cannot use it. We can't paper trail. We don't know where the money came from. So please, no cash, no cash, no cash. A gift fund, which is down here. It's a monetary gift that can be given for the purpose of closing costs or down payments. This can be given from mom, dad, brother, sister, grandma, grandpa. This helps you. This will help you. You can use this as collateral for your down payment and closing cost. It is a gift. It does not need to be repaid. If you have to repay it, then you do so after closing. But technically, it's a gift. You don't have to repay it. Gifts are acceptable by most lenders. And that being said, I'm going to move on to the next verification of the segment, which is going to be number 3, credit. We do have to run our own credit report. We cannot use an outside credit source. It will not be accepted. If you shop around, just had your credit run, sorry, but we still have to run our own. If there are multiple borrowers on the loan, we will always use the lowest middle FICO score that is reported from all 3 agencies. And the agencies, you've got Equifax, TransUnion, and Experian. These 3 report, and they give you your FICO score, which is the Fair Isaac Corporation. You can have bad credit, fair credit, good credit, or superb credit. The better the credit score, the better the pricing gets in respects to your interest rate, pricing, and other aspects of the loan. I have seen credit scores. Actually, I haven't seen a credit score lower than 500 since I've been working. Other people have. They do exist. Can we do a loan for someone with less than 640 credit? Absolutely. But you're going to be paying more as a consumer for the loan and probably for your interest rate and mortgage in the long run. 639 or less. Let's get that credit score up. Let's give some time to get that credit score up. Let's rebuild it. And it's only going to help you out in the long run. Fair credit, you have scores between 640 and 679. Your good credit, 680 to 739. And in our industry, anything above 740 is pretty much golden. This is where you want to be. For the most part, someone with a 740 credit score is going to have the same pricing options as somebody with an 800. But once you get to that 639, you see a difference. So I do have some tips in order to help you with your credit. First one, no late payments. Big. Do not have any late payments of 30 days or more. Once a credit or a car or a mortgage bill is paid late, after 30 days, it automatically affects your credit score. And not only that, it gets reported to the agency and it lingers on your credit report for 10 years. You're like, well, I haven't missed a payment in so long. But we know, but it still shows up on your credit report. One late payment will stay on your credit report for 10 years. Make your payments on time. Okay. Also, another tidbit for credit to help keep your credit score up so it doesn't start to go down is the 30% threshold. A lot of you want to stay under your 30% threshold on your maximum balance on your credit cards. So for instance, if you have a credit card that is $10,000 maximum balance, 30% of that is going to be $3,000. If you go above 3,000 and you pay it off that month, no problem. It's gonna your credit's gonna, you're gonna be building your credit. It's gonna be reporting good. But the longer you stay above that 30% threshold, is the longer your score will negatively be impacted, and you'll see a reduction in your FICO score. So my suggestion: stay under that 30%. If you go above it, pay it down. Do not close and definitely do not open any new lines of credit during your loan process, or anytime prior to. If you have to close a line of credit for some reason, you got too many credit cards, choose one that has the shortest lifespan. If you have a credit card that you just opened about a year ago, it's not going to affect you as much as a credit card that you've had for 10, 15, or 20 years. You are erasing that entire credit history if you get rid of a credit card that you've had for a very long time. So the longer you've had a card, keep it open. Do not open. I've run into this. A lot of people, when they're buying a home, what do you do when you buy a home? You go shopping for furniture, go shopping for china, appliances. You go to the Home Depot, and what do these salesmen do when you're at the store? They talk you into, oh, we can get 0% financing for the first 12 months if you open up and buy this with this credit card. Oh, that's great. Let me buy my sofa and this new end table and this coffee table and this kitchen table and all the trimmings. And you open up that credit card and you haven't closed your loan. No, don't do that. It's so bad. Please don't open any new lines of credit until you're done with your loan. It will jeopardize the entire process. When you buy a new home, the deal, sorry about that. The deal is still going to be available after you buy your home. So just wait, buy your furniture then. What it does is it becomes an additional expense if they have to run another credit report before you're closing. And expenses are our fourth and final item when it comes to qualifying for a loan. If you're on the threshold on your DTI, which is your debt to income ratio, having an extra expense might push you over the cliff and you might not qualify for the loan. So when doing a loan, we qualify you by your credit, your income, your assets, and your expenses. And that's how we get to the DTI, your debt to income ratio, which I stated before has two magical numbers. You have the front end ratio, which is your principal, your interest, and your taxes and insurance. In the mortgage industry, we call it PITI, P-I-T-I, PITI, principal, interest, taxes, insurance. And the back end ratio is your PITI plus any other revolving or installment debts that you may have for the month, whether it's credit cards, auto loan, boat loan, student loans, anything like that, leases. That plus your PITI is your back end ratio. Now, credit comes into play when, for the front end number, you can go over this at times, but conservatively, for a conventional loan, 45.9 and 49.9 are your thresholds. You do not want to go above these numbers. Otherwise, we'd have to go into a different loan product for FHA, which would you can increase the back end number here. 45.9 and 56.9. So how do we get to those two numbers? Oh, by the way, maxing these out, they leave no room for error to work with. So if your income comes in lower or your taxes come in higher and you're already at the threshold, then we have to figure out something else. Maybe we have to buy down the rate, or we have to show more income. Maybe you need a co-borrower, something like that. But there are instances when the front end ratio can go higher than 45.9. And this is, like I said, happens with somebody with stellar credit and no expenses. That being said, these are the types of loans that we got. I'll go into the calculations in just a minute. But conventional loan. Conventional loan is a mortgage loan that is not backed by a government agency, and conforming conventional loans follow the lending rules set by the Federal National Mortgage Association, which is Fannie Mae or Freddie Mac, the Federal Home Loan Mortgage Corporation. FHA is a Federal Housing Administration. It's a loan that is insured by the Federal Housing Administration and issued by an FHA approved lender. FHA loans are designed for low to moderate income borrowers. If you want to put maybe less of a down payment on your home, or if you have high expenses, FHA would be the way to go. VA loans, we also have those for our veterans as well. Why would someone do an FHA loan? One reason would be the credit. Maybe they have poor credit and need help, or maybe they came out of a bankruptcy less than 4 years ago, but more than 2, and they want to refinance. We can do this. I just did a loan for my mother. She claimed bankruptcy 2 years ago, almost 3 years ago. And as in April, her discharge was 2 years, and I was able to get her out of her revolving adjustable home equity line of credit and refinance her first mortgage into a fixed rate under the FHA guidelines after 2 years of bankruptcy. So that is another reason why someone would do an FHA loan. Or maybe they don't have a plethora of assets saved up for down payment and closing costs, want to put down 3.5% payment, which you can certainly do with FHA loans. Conventional, they usually require a minimum of 5% down payment. Are there programs for first-time home buyers? Yes, there are, but they're usually income and area restricted, and they vary from region to region, person to person. Most people, and I'm in Yonkers, so this is Westchester County, New York. Most people in Westchester and Rockland counties in New York don't qualify because, well, simply they make too much money. And I'll come back to that in just a few moments, but I want to show you the calculations on how we get the debt to income ratio. Now, I apologize because I had to upload this form that I hand wrote, so it might not be as clear. But this is a basic pre-qualification cash flow worksheet that I took from my previous institution and took with me because I like the layout and I like the breakdown. Now, on the second line here, you've got your mortgage amount for the term in years, which is normally a 30 years loan. For a loan, we have the loan amount of 500,000. Basic interest rate, I just put in a number. It could be lower, it could be higher. I did a basic interest rate of 3.25%. Now, based on these numbers, a loan amount of 500,000 at 3.25, your monthly principal, interest, taxes, and insurance, your monthly principal and interest payment is $21.76. So how do we get to those two numbers? Well, first one here is your monthly housing expenses. That's your principal, interest, taxes, and insurance. You take your principal and interest payment, which is $21.76. Then we add your property taxes. Property taxes divided by 12, it's a monthly payment. So if your property taxes are $12,000 a year, then you're paying $1,000 a month. We add that $1,000 to the principal and interest, and then we take another 1/12 of your homeowner's insurance. Could be $100, could be a little less, could be a little more. But on average, I put, just for a number, I put $1,200. You divide that by 12, it's $100. So your total monthly housing expenses comes to $3,276. Then you have your back end, which is your fixed monthly payments. Your fixed monthly payments are going to be any minimum payment on your car loan, boat loan, student loan, credit card payments. For all intents and purposes, I put a $500 car payment and a $200 credit card payment. So for a total of $700 a month. You take that 700 and you add it to your principal, interest, taxes, and insurance, and you get $3,976 for your back end ratio. Now, how do we get to the ratio itself? Well, what we do is we take your annual salary divided by 12. If you're making $100,000 a year, just nice round number, I figure it's an easy calculation. What we do is we take your annual salary of 100,000 and we also divide it by 12. Why 12? Because there's 12 months in a year. Makes sense. So your monthly income comes to $8,333.33. So in order to get that front end ratio, you take your front end number, you got A, which is your monthly housing expenses of $3,276. You take that number and divide it by your annual monthly income, which is 8,333, and you get a percentage, 0.393. So now you're at 39% on the front end. Great, beautiful number, love it. It's under 45, I like it. Now you do the same thing with your back end expenses. You've got 3976 divided by the 8,333 comes to 47.7. Good. It's under the 40. It's under the 49. That's where we want it. If it were FHA, we can go up as high as 56. If you had any more expenses than the $700, obviously this is going to raise your number up a little bit. So we would either have to show more income to stay in conventional or flip it to FHA just so you can qualify. But this is how we qualify and do the math on figuring out your debt to income ratio. That being said, there's just one more thing I would like to talk about, and that would be loan to value. Loan to value, LTV, is the amount of money of your financing versus the value or purchase price of your home. When you're buying a home, unless it is a VA loan, which is the veterans loan, which we do, the buyer is required to put down a down payment. Anything less than 20%, the buyer will be obligated to pay PMI. PMI is your private mortgage insurance, and it's to protect the lender and nothing more. It doesn't benefit the borrower whatsoever. Simply said, it's an avoidable monthly expense if you put down 20% or more during the initial loan process. On a conventional loan, if you put less than 20% of down payment, you have to pay your PMI. But once your loan to value reaches 78%, your PMI is automatically eliminated. You do not have to pay PMI anymore. It erases whenever you get to that point. Your next bill will be 100, 200, whatever it might be, lower on the monthly payment. Now, your loan to value is simply if your home is $100,000 and you put $20,000 down, your loan to value, you now have 80% left on your on the loan to value. That's 80%. 20 is 100. $20,000 gives you an 80% loan to value. That's how they figure it out. The higher the price of the home, the more money it is to get to that loan to value. But on FHA loans, this is important, guys, for the borrowers who are moderate to need a little extra help with those back end ratios or down payment and closing costs. On an FHA loan, the borrower will be paying private mortgage insurance for the entire life of the loan. Even at 78% loan to value, they're still going to be paying that private mortgage insurance and that monthly expense for the entire life of their loan. The only way to get out of paying that is to do a refinance. On VA loans, the veteran does not have to pay PMI. It's one of the benefits of being a veteran and doing a veteran loan. They also have a 0% down payment option. one of the benefits that lenders like to thank the servicemen and women of this country, and giving them loan options like that. I think it's a great product, and anybody who is a veteran should definitely see if they are eligible in qualifying for a VA loan. So that being said, I hope I didn't ramble on too much. I apologize. I haven't spoke in front of this many people since I was young Seward in Macbeth on stage in front of everybody. So here is my information one more time. I'm going to minimize this and see if there's any questions in the chat. If anybody has anything that I could take a few minutes and maybe answer some questions for you guys, or if you want me to clarify on one of the topics I talked about previously.
Well, yeah, on
Oscar says, "Who's that waiting in the room?" That would be Christopher Conlon. He's another loan officer here at Hudson United, and he's the manager of the loan officers here. So
he's the one checking up to make sure you're saying all the right things.
I think so. Absolutely.
How do you do, Christopher?
I'm sure I'll get some feedback on this later on, but being that this is my first presentation doing this, I was, a little nervous, but hey, live and learn.
Yeah, real quick, when we bought this house, my father-in-law is the one that put down the down payment, which helped, that whole loan process. And now we're doing the refinance, which is bringing the interest rate down. What am I getting? 1 point?
You are saving a full percentage point on your interest rate, which I think is like in your scenario, I want to say you're saving about $457 a month. I think if memory serves correctly, based on what you have left on your outstanding balance on your mortgage versus your current interest rate. I think you're paying 3.99 or something like that. I'm getting you 2.99. So you literally are saving a full percentage point. Not only that, but you're eliminating another X amount of dollars on your interest over the life of your loan. Now, Oscar and his wife Raquel aren't going to be in their home for 30 years. They already told me their plans on moving to Spain. And but what we're doing is we're saving them instant money, saving them interest, and everything else they're going to make back when they sell their home in 5 or 10 years, whatever it may be. Same thing with Mr. Pucci from our group. So, I'm getting him a great rate, and he's getting instant money savings that, plus now that he's doing a refinance, as soon as we close, he's also going to skip a month of not having a mortgage payment, which I don't know if I told you that, but that's another benefit too. Be like, hey, all right, we close in November. I don't have a payment till January. That's awesome.
Oh, see, I like you now. I like you more. I had a question, but it left my mind. So like I said, I'm saving 1%. So people that have a 5%, 6% loan, that's a whole new world for them, right?
That's a whole new world. They can save anywhere between 2 to 3%, depending on all the factors that I went into. Credit, loan to value, everything else comes into play. But on average, let's just say Mr. and Mrs. John Doe are paying 5.25% on an adjustable mortgage, or maybe at the time they did their first mortgage, they had bad credit, or something came into play where they had to go with a specific product and they just had to settle on a 5.25% interest rate. Happens all the time. Now maybe their credit's better. Maybe they're making more money. Maybe they're doing an FHA loan and they want to refinance, get rid of that PMI payment, save an additional 1 to 2 to 3, whatever it could be, hundreds of dollars on that, plus the interest and monthly savings. Typically speaking, in today's market, anybody paying over 4% is in prime position to do a refinance and save some money. The time to recoup, we calculate that. when we're doing our estimated closing costs. We got a great Excel spreadsheet that we can work with, calculate the monthly savings, interest, everything. If it's less than 4 or 5 years, we always think that it's absolutely worth it to the borrower, not to do the refinance, save your money, and make your money back. Less than 4 years, that's great, especially if you're going to be there for another 15, 20 years in the house. Points are available. Points are another option as well. You can buy that rate down even lower.
Cool. One quick question.
Sure thing.
Some refinance people say, hey, you have a 30-year loan. We're going to refinance it to a 15-year loan. What is the advantage to keeping a 30-year loan versus bringing it down to a 15-year loan? What does that look like in terms of out-of-pocket money monthly?
It's a very good question. So what you're pretty much doing, one, you're going to eliminate 15 years worth of interest payments. So depending on your loan, you are just the size of your loan, you are getting rid of all 15 years worth of interest. But what you're also doing is you're also being obligated to pay almost maybe double or a monthly mortgage payment. Let's say your monthly mortgage payment was like $2,500 with everything included. Now you're got a shorter loan, so your principal and interest
stack
are
up.
increased. Yeah. So now maybe you're paying $3,500, $3,600. So now you're obligated to pay $1,000 more a month, but that $1,000 more a month is going to save you $80,000 in interest. We're just spitballing here, but you could be saving interest. For people that are going to be staying in the home for a very long time, it's a personal preference. Some people will fight you on it. Some people like doing it. New York is a no pre-penalty state, so you can do a 30-year loan, save more money on your monthly payment, and with that savings, like in your case, Oscar, you're for $450 a month, you can take that $450 and you can apply it to your principal balance, and you can attack your principal that way. You're eliminating your interest, and you're getting more equity in your home a lot faster. Eliminating your interest, and if somebody makes, some lenders will do a biweekly payment, which is an option. Now, biweekly is every 14 days, like your paycheck. It's not semi-monthly; it's every 14 days. So, 2 months out of the year, there's going to be a period where you make an extra, maybe half payment or full mortgage payment that month, twice a year, 2 months out of the year. So you get 3 paychecks a year too, which is good for the people who are getting paid bi-weekly. Like, oh, I get 3 paychecks this month. Yes. But what that does, those bi-weekly payments on a 30-year loan, it eliminates about 4 to 6 years on your loan by making 1 extra mortgage payment, 1 to 2 extra mortgage payments a month. Your principal and interest are always going to be the same throughout the life of your loan, but your amortization of interest versus principal is going to be structured differently throughout the life of your loan. Typically speaking, the first 15 years of a loan, the borrower is going to be paying more interest than they are principal balance. After year 15, it starts to heavily favor more principal than interest. You're attacking, especially the first 10 years. It's principal, principal, principal. So if you're saving any money, you have any extra money, you can always make an additional principal only payment and eliminate some of that interest as well.
So this sounds like there are a lot of moving parts. There are a lot of options. So people should call you and talk to you directly to see exactly which option is best for that. Because I had talked to a bunch of different loan officers, and you had the best, I think the best philosophy of, like, for you on what you want to do, this is going to be the best way. So it's not like you go to Rocket Mortgage or something and just, fill out a form and may not be the best solution for you. And again, what we say with Phil, this is the reason Phil has a show and we bring on experts. Don't try to do stuff yourself. There are experts there to help you and save you money, time, and headaches in the long run.
I mean, my thing is, why are you going to go through the headache of, trying to do something yourself? Chances are you're going to miss something. I mean, the chances of, and especially in something like this, you don't want to be the amateur in the room. Okay, be like, yeah, I know what I'm doing. Yeah, you're doing this wrong, and I'm sure you've had that. I'm sure you've had where people assume that they have become an expert because they saw a YouTube video.
How to do your own mortgages on YouTube.
Next thing you know, next thing you know, there's a foreclosure on the house because you can't make the payments.
It's like
We do
taxes. Nobody
foreclosures?
told me I had to pay taxes.
Yeah, taxes are a must. Pay your taxes. You don't want to be property taxes. You don't be Wesley Snipes. Pay your taxes.
Exactly. There are consequences. But I had a couple questions too, Rich. Just really
Shoot.
about the credit score versus how much you put down on your for your mortgage. So let's say you do have that credit score of 600, aka maybe 550. Is there any hope for somebody to build their credit up, or what do they have to do to kind of be able to get their own home?
Okay, so great question. For instance, let's just say you have a 600 credit score, all right,
Mm-hmm.
and you're shopping for a house in the $400,000-$500,000 range. Now your wife is with you, and you both want to apply together.
Mm-hmm.
Based on a $600 FICO score. Based on a 600 FICO score, I'm just spitting out numbers. But on that scenario, oh yeah, everything's good. I've got the assets, I've got this, I've got that, but my credit might not be low. On a 600 credit score, you might be paying 4.25% interest rate on that $500,000 loan. But when your wife's credit, she's got 720, 740.
Right.
That 4.25 for her doesn't exist. She might be paying 3.25. That's the give and take to having low credit. Also, there are not too many lenders that are going to lend under a 620 or 600 FICO score. There's only a few people that will lend on with somebody that has really botched credit. In which case, it's going to cost more money. Your closing costs, you're probably going to be paying some points for hits on your credit score and for financing a loan, because it's all about trust. Like, you have bad credit, but we have to trust that you're going to make your mortgage payment on a monthly on a monthly basis. We're not going to lend to anybody that doesn't have a good outstanding credit history. And we will work with lenders that will do loans for less than 600 FICO. Now, if you go to a banking institution or any place like that, that might be a portfolio lender where they're lending on their own money and they're lending on their deposits. I can guarantee you they're not going to lend to you or anybody else that has less than a 700 FICO score. But that being said, that's where the pricing comes into play. The difference between a 680 credit score and a 720 could be 1/4 or 1/8% difference on your interest rate. And if you multiply that by 30 years, you're going to be saving a heck of a lot of money. I got people looking at me through the grass.
Are we? So Phil, are we looking to bring in Dwayne and say, hey?
Yeah. I've been calling Dwayne, and Dwayne, if you're watching this, I've been calling you. Pick up the phone. Pick up the phone. Yeah. So basically, everything is kind of workable based on, but you have to really talk to an expert to find out where you stand. You can't just really go based on your Credit Karma score and be like, yeah, I should qualify based on Credit Karma.
So here's the thing with Credit Karma. It's not your real FICO score. What's being reported to places like Credit Karma, Credit Guru, all these things, it's a Vantage score. And Vantage is different. Vantage was created by the three big head honchos, Experian, TransUnion, and Equifax. And what they did, it's it's a tool that they created, one, to make money, but two, to please the consumer. And they control what's being reported in these Vantage scores. So you can look at your Chase app and your Credit Karmas all day long and be like, oh man, I got a 780 credit score. I'm in great condition. And then when you actually get your credit ran,
Right.
you might have a 730, 735. So that's the difference. Everything that they control what's being reported. It's a Vantage score. It's not your credit score. Now, if for the consumer, anybody who wants, they are entitled to one free credit report every year. And they can do so by going to annualcreditreport.com. It is free of charge, and you can get your credit report for free one time per year. If you have not done so this year, it's October. You can get one now, and then 2.5 months from now, in January 2021, you can get another one to see where you stand with credit. But that is the only place and that you can get one free credit report every single year is annualcreditreport.com.
Okay, I know I have only time for maybe one more question. So
no problem.
I don't know anybody that doesn't have a student loan. I mean, if they went to college, they have a student loan. I've known people trying to pay off their student loan, 20 years, they're still trying to pay off their student loan, depending on what their career is. Is that a big hindrance when it comes to getting a mortgage?
It depends on the monthly payment. If they've got enough monthly income to supplement their expenses, then the answer is no. But what we find is a lot of the times, if people have a plethora of expenses or debt, what they do is they cash out refinance, which is totally available. What they do is they take out, maybe they have $200,000 left on their home. Their home is worth $500,000. I got $100,000 in student debt and credit card debt that I want to eliminate. I'm going to refinance, do some cash out to pay off my student loan and my credit card debt and eliminate it completely. Because now I'm paying 3.5% on $300,000 rather than, look, I have credit cards, you have credit cards. I think my average interest rate on my credit card is anywhere between 16.5% and 22.5%. I'd rather pay a fixed rate of 3.5% on my credit cards than 16.5% over trying to pay it down and obligated. But it's no, as long as you have enough income to supplement, student loans are not going to be a hindrance. But people like being debt free. Cash out refinancing is a great option for those who have the equity in their home and want to eliminate their debt completely.
Wow. All right. Thank you so much for coming on, Rich. That was awesome, man. That was really exciting information. Those of you who are watching out there, I know that you've gleaned a lot. I know you have a lot of questions. Rich's information is right there on the banner throughout the presentation. He gave his information as well. Give him a call and, get some more information, personal information as to what you can do to get your own home. You might be comfortable renting, but, owning your own place, there's nothing like it. So give him a call and see how he can help you in that situation. We do have another program coming up. We have Karen Mayo. She's going to be coming on at our 1:00 program, and she's going to be talking about roots of leadership. She has her bestseller book, Mindful Eating, which is on Amazon. So you may want to get the book as well. So please stay tuned. We have some great programs coming up right after this. So we'll see you soon. Take care, everybody, and see you again in an hour.